Have you ever looked at your investment portfolio and felt that pang of regret? You know, that feeling when you realize you made a mistake that cost you money? We've all been there. It's like accidentally setting your money on fire. Totally avoidable, but super painful. The good news is, a few simple adjustments can make a world of difference. In this video, I'm diving deep into the most common investment blunders people make. And trust me, even seasoned investors fall into these traps. But more importantly, I'm giving you the playbook on how to dodge these mistakes entirely. Stay tuned until the end for a bonus tip that could supercharge your returns. Welcome to Business and Wealth Insights, your one-stop shop for all things business and wealth building. If you're ready to level up your finances and make your money work harder for you, you're in the right place. Today, we're tackling those sneaky investment pitfalls that can sabotage your financial goals. Whether you're just starting out or you've been in the game for a while, avoiding these mistakes can save you thousands, potentially even millions in the long run. Before you even think about buying stocks, bonds, or real estate, you need a solid game plan. What are you trying to achieve with your investments? Are you building a retirement nest egg so you can retire early and travel the world? Saving up for a down payment on your dream home? Or maybe you're thinking long-term, aiming to create generational wealth for your kids and grandkids. Having a clear investment goal is like having a roadmap to financial success. It guides your decisions and helps you stay focused when the market gets bumpy. Without a clear objective, you're just throwing darts blindfolded and hoping for the best. Let's say your goal is early retirement. You'll probably want to focus on growth investments that have the potential to generate high returns over time. But if you're saving for a down payment in a few years, you'll want to prioritize low-risk investments that preserve your capital, even if it means sacrificing some potential upside. The point is, your investment strategy needs to align with your specific goals and timeline. So before you invest a single dollar, take some time to define your financial objectives. What do you want to achieve with your money? When do you need the money? How much risk are you comfortable taking on? Once you have clear answers to these questions, you can start building a portfolio designed to get you there. Remember the GameStop frenzy? Or how about the Dogecoin craze? Jumping on board a hot stock or investment trend can seem tempting, especially when everyone's making money, except you. But here's the thing, chasing trends is like trying to catch a falling knife. You're more likely to get burned than to come out ahead. Most trends are driven by hype and speculation, not by real fundamental value. By the time a stock or investment becomes the talk of the town, chances are it's already overvalued. And when the hype inevitably dies down, you're left holding the bag, often at a significant loss. Instead of trying to time the market or chase the latest fad, focus on building a diversified portfolio of solid, long-term investments. Look for companies with strong fundamentals, consistent track records, and a competitive edge in their industries. Investing in index funds that track the broader market is also a great way to participate in the market's growth without trying to pick individual winners. Remember, slow and steady wins the race. Don't let FOMO, fear of missing out, drive your investment decisions. Stick to your plan, ignore the noise, and focus on the long game. Imagine putting all your eggs in one basket. Risky, right? That's essentially what you're doing if you don't diversify your investment portfolio. Diversification means spreading your money across different asset classes, industries, and geographical regions. Think of it like this. If you only invest in tech stocks and the tech sector takes a hit, your entire portfolio could plummet. But if you have a well-diversified portfolio that includes real estate, bonds, international stocks, and other asset classes, a downturn in one area will be offset by the performance of others. Diversification is your best defense against market volatility. It helps you manage risk and protect your hard-earned money. A good rule of thumb is to aim for a mix of stocks and bonds that aligns with your risk tolerance and time horizon. You can further diversify within each asset class by investing in different sectors, industries, and countries. For example, within stocks, you might hold shares in technology, healthcare, consumer goods, and energy companies. The key takeaway here is, don't put all your eggs in one basket. Spread your investments across different asset classes to create a portfolio that can weather market storms and deliver consistent returns over time. Mistake number 4, ignoring fees and expenses. You know those tiny fees and expenses that come with investing? The ones that seem insignificant at first glance? Well, those seemingly small percentages can add up over time and eat away at your returns. It's like having a leak in your money bucket. It might seem small at first, but over time it can drain your wealth. Every investment comes with costs, whether it's the expense ratio of a mutual fund, trading fees on platforms, or even hidden charges buried in the fine print. These fees might seem small, like 1% or 2%, but they compound over time, just like your investments. Let's say you invest $10,000 and earn a 7% annual return. If you pay 2% in annual fees, your net return drops to 5%. Over 30 years, that seemingly small 2% difference can cost you tens of thousands of dollars in potential earnings. The good news is, you can minimize the impact of fees by choosing low-cost investment options. Look for index funds and ETFs with low expense ratios. Consider using a discount brokerage that charges minimal trading fees. And always read the fine print to understand the fees associated with any investment before you hit the buy button. Chapter 5. Mistake number 5, timing the market. Trying to time the market is like trying to predict the weather. You might get lucky sometimes, but more often than not, you'll end up soaked. The stock market is notoriously unpredictable. Even the most experienced investors and financial analysts can't consistently predict when the market will go up or down. Trying to time the market often leads to buying high and selling low, the exact opposite of what you want to do. When you're driven by fear and greed, you're more likely to make emotional decisions that hurt your portfolio in the long run. Instead of trying to time the market, focus on time in the market. Invest consistently over time, regardless of what the market is doing. This strategy, known as dollar cost averaging, helps you buy more shares when prices are low and fewer shares when prices are high, averaging out your cost basis over time. Remember, investing is a marathon, not a sprint. Stay invested for the long haul, ride out the market's ups and downs, and let compound interest work its magic. Chapter 6. Mistake number 6. Letting emotions drive decisions. We've all been there, checking our portfolios obsessively, feeling a rush of excitement when the market's up, and panicking when it takes a dive. But here's the hard truth. Letting your emotions dictate your investment decisions is a recipe for disaster. Fear and greed are two of the most powerful emotions, and they can wreak havoc on your portfolio if you let them take the wheel. When you're driven by fear, you're more likely to sell your investments at the worst possible time, locking in losses and missing out on potential rebounds. On the other hand, greed can lead you to make impulsive decisions, like chasing hot stocks or investing in risky ventures that promise unrealistic returns. Remember, when an investment opportunity sounds too good to be true, it probably is. The key to successful investing is to remove emotions from the equation as much as possible. Stick to your investment plan, ignore the noise and hype, and don't make rash decisions based on short-term market fluctuations. If you're feeling overwhelmed, consider working with a financial advisor who can provide objective guidance and help you stay on track. Chapter 7. Mistake number 7, not continuously educating yourself. The world of finance is constantly evolving. New industries emerge, technologies disrupt traditional markets, and economic landscapes shift. What worked 5 years ago might not be the best strategy today. That's why it's crucial to be a lifelong learner when it comes to investing. Don't rely solely on what you learned in a finance class years ago or from that one book you read. Stay up to date on market trends, economic indicators, and investment strategies. Read books, listen to podcasts, follow reputable financial websites, and consider taking online courses or attending seminars. The more you learn about investing, the better equipped you'll be to make informed decisions, manage risk effectively, and adapt to changing market conditions. Remember, knowledge is power, especially when it comes to building wealth. Now, for that bonus tip I promised, reinvesting your dividends can supercharge your returns and help you build wealth faster. Think of it as free money that makes even more money. When you invest in dividend-paying stocks, you're essentially getting paid to own a piece of a company. Those dividend payments might seem small at first, but when you reinvest them, those dividends buy more shares, which generate more dividends, and so on. It's the magic of compound interest in action. Let's say you invest $1,000 in a stock that pays a 3% annual dividend. If you reinvest those dividends, after 30 years, you'll have over $2,400, more than double your initial investment. That's the power of compounding. By reinvesting your dividends, you're essentially putting your money on autopilot, letting it grow exponentially over time. It's one of the simplest yet most effective ways to accelerate your wealth-building journey. Now, I want to hear from you. Have you made any of these investment mistakes? What strategies have helped you succeed in the market? Share your experiences and insights in the comments below. Let's learn from each other and build a community of savvy investors. If you found this video helpful, don't forget to give it a thumbs up and subscribe to the channel for more actionable tips on building wealth and achieving financial freedom. Hit that notification bell so you never miss an upload. Until next time, keep investing smart, stay informed, and keep crushing your financial goals.